Hey everyone, welcome to another live stream. So I actually started streaming about an hour and a half ago. Unfortunately, did you know that you have to enable it from here? Well, I had no idea. I had no idea that I had to enable live streaming from there. Anyway, what we're doing today is I'm taking a look at steel producers. These are the companies that I'm looking to review today. I've already done a review of fertilizers as well as chemicals as part of the basic materials sector. And so this is the next in line, steel producers. I have zero background in steel producers, by the way, but I'm leaning on help from a bunch of sites, including there's Zach's right here. And it just includes a bunch of useful metrics that I can use to compare each individual company that I'm reviewing to the entire industry. So it gives me expected PE ratios, it gives me like expected return on equity, debt to equity ratios, current ratios. So yeah, it's useful. This is useful to lean on, and I'm not entirely sure how something compares to the rest of the industry. Anyway, so I've already gone through this exercise where I picked the industry from a list of from this screener. I've added debt to equity as well, so I avoid companies that have high debt to equity ratios. These are really annoying, and also I don't consider them halal. I mean, different people have different levels of comfort. I don't consider high debt to equity comfortable from a halal perspective, and so yeah, it's really just you have a lot of companies, especially in like the commodity sector, even energy, very leveraged. So really, like that actually higher than revenue, and so yeah, I try to avoid those. And what I've done is I've sorted them by debt to equity, and I've gone through a couple of them already. Right now, I'm looking at this company called Sim, which is Grupo Simic. Grupo Simic, headquartered in Mexico. And so anyway, reviewing the financials, zero debt. So you know the drill. Kind of start with looking at revenue, and you can see revenue kind of peaked in 2012. Actually, even before that, 2008, right? And then kind of dropped for a while until 2019. So we're at 2019 now. No debt, so you don't have to worry about that. Let's take a look at their assets. $5 in assets, four intangible book. Book per share is 11, so decent. No dividends. Cash per share is 0.85. 3.45 liquidation to common. All right, that's decent. So you kind of expect, okay, you have like, assuming the company goes bankrupt, you're probably going to get around $3.50, right? And it's going to trade somewhere between, let's say, tangible book. So tangible book is 4.75. It's going to trade between cash and tangible book, maybe a multiple of tangible book. I don't know. Like, this is a new industry. I have no idea. Let's take a look at the margins. Those will determine the multiple that we'd be comfortable applying. So let's see, 12 gross margin. EBITDA is 8%. Oh, look at that! Like actual metrics that I pull in from different places, from a different place, to kind of let me know. Okay, this is like the average for the industry. So again, I don't think it's from Saks. It's from a different source, but it's good to know. ReadyRatios.com. You can see that up here. All right, anyway, so 12, 8%, and then 7% operating margin. Okay, it's pretty low, 7% operating margin. And net income is -5. Okay. But you can see historically that it's actually been okay. Like it's been around the 7%, maybe 7% on average, which is actually not that bad. It's not that bad at all. Earnings per share 0.38, so roughly 0.3 historically. Okay, operating cash flow is positive, so there's that. At least their cash reserves aren't depleting. Asset turnover is dropping again. That's good. Return on equity, roughly maybe 7%, 7% on average. Yeah, the negatives really get negative. Return on invested capital. Yeah, that's higher than 10%. Okay, all right. I mean, so you can see, I don't have multiples to compare this to, but I mean, I'm kind of thinking it's gonna hover around tangible book, a slightly higher or lower based on their operations, and their operations seems to be doing okay. It looks like 2019 was just a really bad year, maybe for iron. Can we see iron prices? Maybe you can see iron ore price, 3 years. So maybe 2019 was just a bad year for iron. Why is it taking so long? And then you don't have 2020 data, which I really hate. Like, especially whenever you have international companies, by the time they actually file with the SEC, which is when the data actually shows up, they don't do that promptly. Like, we're in 2021, I can't see 2020 data. We're in March 2021. Unbelievable. Anyway, so yeah, what do I say? I don't know. Like, if I were to estimate price, here's how I would think about it. I would probably say, all right, multiple of EBITDA, maybe say 20, 15 times EBITDA gets us to roughly $4.50. And then your tangible book is 4.75. Okay, yeah, that'd be what I would estimate this to be, assuming it's like a commodity business, and that's it. I don't know if this is true. Let's see. Oh, price is 13. Even historically, like, it was 10. So it trades at, your enterprise value is 2.64. It was 2.64. Really? Seems really low. That can't be right. It can't be 2.64. Like, why is it a fraction of? Yeah, it must be a mistake. Enterprise value per share. Yeah, enterprise value per share. All EV over share. What is the issue? Price, enterprise value per share. 2.64. I mean, there's not a huge difference between. Oh, that's manually calculated. So enterprise value per share can't be that low compared to the debt that they have. They don't have any debt. Like, enterprise value should be similar. Like, it's basically your price per share, the market cap, plus whatever cash you have available minus any debt that you have. They have zero debt, so enterprise value per share should be higher than price per share. And yet, what are we looking at? Call EV per share. I think you need to divide by FX. I'm not really sure how they're calculating EV. Let's see. Yeah, that makes it worse. So what I'll do is, I'm just gonna do call price times number of shares that you have available. That gives you your EV, plus, well, we are using EV everywhere else. EV per share. So it looks like EV is not giving us the value that we need. Anyway, I'm gonna look into that to understand why. I think it might be that the EV column, 49. No, that's not right. It might be that the EV column is, yeah, there must be something wrong there. I don't know. I'm gonna look into it and figure out why EV per share. much less than price per share. Yeah, there's a bug. We'll look into that. Cool. Okay. Yeah, but overall, like, what am I gonna say? 12 bucks. You're looking at 3 times revenue. No, EV over revenue. Yeah, 3 times revenue. That's pricey. 2.7 times tangible book. 38 times EBITDA. Whoa, that's pricey, huh? 38 times EBITDA. Yeah, I don't see it. Like, I bet steel's just flying high, huh? Price of steel. Should find a site where it can show me